Christian Magoon, the average closed-end fund is trading at a 9% discount to its net asset value. That's almost double the long-term average. So what's going on?
Yeah, there's a lot of fear in the marketplace, Greg, and we see that in closed-end funds. They have this unique feature of their NAV and then a market price that can trade above or below based off kind of supply and demand. Right now, it's, like you said, almost 10% below on average its NAV. So you're buying with 90 cents on the dollar, you're buying $1 worth of assets. We think it's an opportunity long term. Certainly it's a bit of a contrarian play. It's fear about the Fed and rising rates. That's kind of what it boils down to.
And how quickly do these discounts revert to the mean, to the average discount?
Well, in the 2007-2008 financial crisis, about 12 months afterward, we saw discounts revert back to their mean. They had gone as low as, in some cases, 25% on average, and gone back to that 4.5% mark within about 12 months. So it'll be interesting to see what happens in this occurrence. Certainly this kind of fear about the Fed raising rates has kind of stretched out for a long time, so it could last more than that.
And a lot of the fear of the Fed or higher rates when it comes to closed-end funds is due to the leverage involved. How much leverage is there involved in closed-end funds?
Well, most of the leverage in closed-end funds occurs in the debt side. Now, debt closed-end funds make up 2/3 of all closed-end funds. They leverage about 30% of their portfolio. They can go up to about 33%. On the equity side, which is 1/3 of the market, there's not as much leverage used. In fact, many funds don't use any leverage. So that's definitely the issue with these funds. People are concerned about leverage, and to a certain extent, the asset class these funds are exposed to, which again are predominantly debt closed-end funds.
And you run a fund, it's the YYY, it's the Yield Shares High Income Fund.
That's right.
And it has 1/3 of it is in equity or covered calls closed-end funds, the rest is in debt closed-end funds. It's down around 11% this year, but it yields 11%. I guess you can say there's a wash right there.
Yeah.
Can you talk about the construction of this fund and why you expect it to do well going forward?
Yes. So this is an index-based ETF. The index looks at the entire closed-end fund universe, screens for some market cap and liquidity, and at the end of the day scores all closed-end funds based off 3 criteria: size of discount to NAV, amount of distribution, and then liquidity of the fund. The top 30 funds in terms of the overall ranking actually become the index. So that means that it could be equity, could be bond, could be a mix. It all depends on what that criteria tells the index to do. So currently 1/3 equity closed-end funds, 2/3 debt closed-end funds. 30-day SEC yield is a little over 10%. So we like to say you're paid to wait, hopefully poised to rally. Average discount is about 12% now of the closed-end funds YYY holds.
And this is an ETF, or an exchange-traded fund, which holds closed-end funds, just to make sure.
That's right. This is a fund of funds, an ETF that trades on the New York Stock Exchange, YYY, and then holds a basket of closed-end funds from BlackRock, Nuveen, Eaton Vance, 30 funds within that basket.
All right, and then finally, what happens if rates just continue to stay low, that the Fed really doesn't move? Look, they haven't moved in a long time. A lot of people say they're not going to move till earlier, even mid-2016. So what happens to the YYY then?
Yeah, so it should stay flat, if you will. In the meantime, investors hopefully will continue to get that monthly distribution. Again, that yield is about 10% on average. So hopefully that's above average market income while they're kind of waiting for those discounts to compact back to historical levels.
All right, well, thanks a lot, Christian.
Thanks, Greg.
Thank you for watching The Street.